Listen, you can hear the screws turning on mortgage lending. Welcome to the Property Imperative Weekly, to the 17th of February 2018. Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. In this week's digest of finance and property news, we start with Governor Lowe's statement to the House of Representatives Standing Committee on Economics. He continued the themes of better global economic news, lifting business investment, and stronger employment on one hand, but weak wage growth and high household debt on the other. But for me, one comment really stood out. He said, "It would be a good outcome if we now experienced a run of years in which the rate of growth on housing costs and debt did not outstrip growth in our incomes in the way that they did over the past 5 years." This is highly significant given the fact that lending for housing is still growing faster than wage growth currently, and home prices are continuing to drift a little lower. So don't expect any moves from the Reserve Bank to ease lending conditions or expect to boast in home prices. More evidence that the property market is indeed in transition. The era of strong capital appreciation is over for now. There was lots of news this week about the mortgage industry. ANZ and Westpac Group have tightened serviceability requirements. Westpac recently introduced strict tests of residential property borrowers' current and future capacities to repay their loans. The change is said to be intended to identify scenarios that might affect borrowers' capacity to pay back their loans. These scenarios include having dependents with special needs that might require borrowers to spend on long-term care. ANZ has added a higher level of approval for some discretions used in its home lending policy for assessing serviceability, thus reducing approvals outside normal terms. And talking of lending standards, APRA released an important consultation paper on capital ratios. Now, this may sound a dry subject, but the implications for the mortgage industry and the property market are potentially significant. As part of the discussion paper, APRA says that addressing the systemic concentration of ADI portfolios in residential mortgages is an important element of the proposals. So they have finally woken up to the risks in the system, but just years too late. We have a significant number of loans in the system currently that would now not pass muster. More about that next week. Their proposals, which focus in on mortgage serviceability, would change the industry significantly, as lower risk loans will be more highly prized, and so expect lower rate offers for lower LVRs, whilst investment loans and interest-only loans are likely to cost more and be harder to find. Combined, this would certainly move the market. The proposals introduce standard and non-standard risk categories. As well as increasing the risk weights for some mortgages, they also continue to close the gap between the advanced IRB internal approach used by large lenders and the standard approach used by smaller players. Those in transition, for example Bendigo Bank, may find less of an advantage in moving to advanced as a result. And you can watch our separate video on this important topic, which covers it in more detail. Whilst the overall capital ratios will not change much, there is a significant rebalancing of metrics, and banks with more investment and interest-only loans will be most impacted. So getting an investment loan will be somewhat harder, and this will impact the property market. The proposals are for consultation with a closing date of the 18th of May 2018. Another data point on the property market came from a new report by Knight Frank, which claims that in 2017, 1/3 of Australian residential development sites were sold to Chinese investors and developers. The share of sales to Chinese buyers has tripled since 2013, but decreased from 38% recorded in 2016. The level of Chinese investment in residential development sites varies from state to state. In Victoria, it's at 38.7% of residential sites. In New South Wales, 35.6% of residential sites. And in Queensland, 7.4% of total residential sites were Chinese. So this is one factor still supporting the market, although in Australia, APRA has encouraged local financial institutions to impose stricter controls, while in China, the government has attempted to moderate capital outflow, with China's central bank imposing new rules for companies which make yuan-dominated loans to overseas entities. The data from the ABS on lending finance, the last part of the finance stats for December, really underscores the slowing momentum in investment property lending, especially in Sydney, although note it is still a significant slug of new finance, and there is no justification to ease the current regulatory requirements. The ABS says the total value of owner-occupied housing commitments, excluding alterations and additions, rose 0.1% in trend terms. Total personal finance commitments fell 0.2%. Revolving credit commitments fell 1.4%, while fixed lending commitments rose 0.5%. There was a small rise in lending for housing construction, but overall mortgage momentum still looks like it is slowing. And the mix of commercial lending is tilting away from investment lending and towards other commercial purposes at 64%, which is a good thing. There is an air of desperation from the construction sector as sales momentum continues to ease. And this despite slightly higher auction clearance rates last week. CoreLogic said the final auction clearance rate was 63.7%, across almost double the volume of auctions week on week at 1,470. Over the week prior, the clearance rate was 62%, with 790 auctions. Both auction clearance rates and volumes are lower than those seen a year ago, when it was 73.2% on 1,591 auctions. There is significant discounting going on at the moment to shift property, and some builders are looking to lend direct to purchasers to make a sale. For example, Catapult Property Group launched a new lending division that will help first-time buyers get home loans with a deposit of only $5,000. The Brisbane-based company encourages first home buyers in Queensland to enter the real estate market now by taking advantage of the state government's $20,000 grant that's ending in June 2018. This is at a time when lenders are insisting on larger deposits and are applying more conservative underwriting standards. Economic data this week showed that according to the ABS, trend unemployment remained steady at 5.5%, where it has hovered for the past 7 months. The trend unemployment rate has fallen by 0.3 percentage points over the last year, but it's been approximately the same level for the past 7 months after the December 2017 figure was revised upward to 5.5%. The ABS says that full-time employment grew by a further 9,000 persons in January, whilst part-time employment increased by 14,000 persons, underpinning a total increase in employment of 23,000 persons. The fact is that whilst more jobs are being created, it's not pulling the rate lower. And many of those jobs are lower paid part-time roles, especially in the healthcare sector. In fact, the growth in employment is stronger for women than men. A rather different story then from the current political spin. In a banking crisis, are bank deposits safe? We discussed the consequences of recently introduced enhanced powers for APRA to deal with the bank in distress this week. There were several well-publicised government bailouts of banks which got into problems after the GFC. For example, the UK's Royal Bank of Scotland was nationalised. This cost taxpayers dear. So there were measures put in place to try to manage a more orderly transition when a bank gets into difficulty. And it raises the question of bail-in. arrangements. Take New Zealand, for example. There, regulators have specific powers to grab savings held in the banks to assist in an orderly transition in the case of a failure, alongside capital and other bank assets. And given the New Zealand position and the tight relationship between banking regulators in Australia and New Zealand, we should look at the position in Australia. So the question is, are deposit funds in Australia likely to be bailed in? Well, the Treasury confirmed that because deposits are not classified as capital instruments and do not include terms that allow for their conversion or write-off, they cannot be bailed in. But we have a catch-all clause in APRA's powers that says that they can grab any other instrument, and deposits, despite the Treasury reassuring words, is not explicitly excluded. So I, for one, cannot be 100% convinced savings will never be bailed in, and that's a worry. I recall the Productivity Commission comment last week that financial stability has taken prime place compared with competition and so customer value in financial services. And the issue of bail-in of deposits appears to be shaping the same way. You can watch our separate video discussing this important topic in more detail. The first round of public hearings for the Banking Royal Commission will focus on lending, including mortgages, credit cards and car loans, we heard during the opening session. The Commission highlighted the large size of the lending market and the significant number of submissions they have already received on misconduct in this area, including those relating to intermediaries, commissions and advice. In addition, as part of the opening address, we were told that some of the major players were unable to provide the full range of misconduct information that the Commission requested. Some players offered just a few case studies and were then asked to provide more detail over the past 5 years as opposed to the original 10 years. But they said they could not meet the required deadline. Based on the opening round, banks are going to find this a painful process, not least because the Commission is publishing information on the sector. In its first release, it pointed to declining competition in the banking sector, with the number of credit unions falling due to consolidation, and the major banks holding 75% of total assets held by ADIs in Australia. The paper noted that 5 of the 20 listed companies that make up the ASX 20 are banks, noting that the major banks have generally achieved higher profit margins than other types of ADIs, with a profit margin of 36.4% in the June quarter 2017. They also underscored that Australia's major banks are comparatively more profitable than some of their international peers in Canada, Sweden, Switzerland and the UK. We expect to hear more from the Royal Commission on unfair and predatory practices. And to underscore this, there was some good news for credit card holders, with new legislation passed in Parliament to force credit card providers to scrap unfair and predatory practices. The reforms include requiring affordability assessments to be based on a consumer's ability to repay the credit limit within a reasonable period from July 2018. This tightens responsible lending obligations for credit card contracts. Next, they've banned unsolicited offers for credit limit increases from January 2019. At the moment, whilst the law forbids providers from making these sorts of offers in writing, offers can be made by phone and other mediums, and this loophole has been exploited but will now be closed. Next, simplifying how credit card interest is calculated, especially banning the practice of backdating interest rate charges. Currently, some providers were attracting new customers with promotional low rate or no rate offers, say for the first month. But if a customer failed to pay off in full in that time period, then the credit card company was often retrospectively applying the new interest rate to previous purchases. This was allowed in the bank's small print, but the government said the practice did not align with consumers' understandings and expectations about how interest is going to be charged. And this will now be banned from next year. And finally, credit card providers are required now to have an online option to cancel a credit card or to reduce a credit limit from January next year. At the moment, some card providers force customers to come into a bank branch to reduce a limit or terminate a card. And when they come in, they're often persuaded not to do it. The asymmetry between fast credit card approvals online and slow cancellation will end. So, in summary, another week highlighting the stresses and strains in the banking sector and the forces behind slowing momentum in the property market. And based on the stance of the regulators, we think the screws will get tighter in the months ahead, putting more downward pressure on mortgage lending, home prices, and the banking sector, something which the RBA says is a good thing. If you found this useful, do like the post, leave a comment, and subscribe to receive future updates. I'm Martin North, Principal of Digital Finance Analytics. Many thanks for taking the time to watch.